Applying for a mortgage is never simple, but it's even trickier when you don't know what to expect. If you're preparing to buy a house for the first time, you can make the process easier on yourself by learning as much as you can ahead of time before you find that dream home. Knowing what to expect allows you to plan ahead and improve your chances on getting a mortgage with favorable terms. What to Expect is a series where I go over the main concepts of obtaining a mortgage, broken down into 3 sections. What you need to know before applying for a mortgage, what you need to know during the mortgage process, and finally, what you need to know after the mortgage closing. The goal of this series is to help you become more comfortable with the most commonly asked questions, as well as general information to get you more in tune with what the expectations are for everyone involved. In the first section, what you need to know before applying for a mortgage, we'll examine what you can set up for success before applying and having your credit pulled to make sure that you're in the best situation possible to make the most out of your mortgage. So here are 7 important topics of what you need to know before applying for a mortgage to ensure that when the time comes, your application will go as smooth as possible. If you want to qualify for a mortgage, it's important to know what kind of monthly payment you can reasonably afford, and this amount may be different compared to what you can actually qualify for. Setting up a budget, going through your required and optional monthly payments can help you determine what monthly amount would be the most comfortable for you. If you've heard the term house poor, this is where that could come in. Being house poor is a term used to describe someone who spends a large proportion of his or her total income on home ownership, which includes their mortgage payments, property taxes, maintenance, and utilities. Individuals in this situation are often short of cash for discretionary items and tend to have trouble meeting other financial obligations, such as vehicle payments and simply just even going out, for dinner or lunch or what have you. Or in the end, they end up just racking up a bunch of credit card debt to offset things. So you don't want to be in this sort of situation if you were to be buying a home. So speaking of credit cards, avoiding unnecessary swiping on credit cards weeks or months before applying for a home loan can have a big impact. This can save you from your credit scores dropping as a result of more outstanding credit card debt. It'd be silly to make a small or medium-sized unnecessary purchase that could jeopardize your opportunity at purchasing a home later. Secondly, new debt may eat into your debt-to-income ratio, thereby limiting what you can afford, even if you pay off your cards in full each month. In other words, it may be best to just wait and make your purchases a month after closing once your mortgage funds. Now, this is also true during the home loan process, so don't go buying that furniture that you need for the new house until your mortgage crosses that finish line. Similarly, knowing how much outstanding debt you've got, along with the associated minimum payments, can play a huge role in the mortgage pre-approval. Again, simply put, the less debt you've got, the more you'll be able to afford on your given salary, all else being equal. It can actually be a win-win to pay down your debt prior to a mortgage application because it'll boost your purchasing power and probably also increase your credit scores at the same time. The result may be even more purchasing power thanks to a lower mortgage rate, which drives payments down and increases affordability. To determine how much debt you've got, grab a copy of your credit report and add up all the minimum payments for the monthly payments. These all eat into your affordability, so eliminating them or reducing them and the balances that are associated with them can help. But I will say, paying off all debt isn't always the right answer either, as it can take away from your funds needed for closing. Just another reason to have a conversation with a mortgage professional. It is helpful to know what guidelines may come into play for income qualifying. The debt-to-income ratio is a big part of that. Your debt-to-income ratio, known as more commonly as DTI, has both a front and a back ratio. The front ratio is referred to as the housing ratio, which is the potential new house payment divided by your total qualifying income. Now keep in mind your potential house payment can include the mortgage, principal, and interest, taxes, insurance, private mortgage insurance or PMI, and sometimes HOA payments. Now you'll pay those HOA payments separately from the mortgage, but they need to be calculated when qualifying for a home. Now all of this together is sometimes referred to as the PITIA. So the principal, interest, taxes, insurance, and association dues. The back ratio, which is a little bit more relevant for qualifying, is simply all of that debt that shows on your credit report, along with this new potential house payment for the new house, divided by the total qualifying income. For the most part, the back ratio of the DTI needs to be below 45% for most first-time home buyers looking to utilize a conventional loan. Now, there are certain scenarios where it can go above, but for reference, 45% is a good line to be below. One simple way to start is by doing a pre-qualification call with a mortgage lender. A pre-qualification is like an unofficial pre-approval, but without the application, the paperwork, or the credit pull. You would go over your basic income and assets along with your credit and debt information. This is done through a conversation with a loan officer who will help guide you with where you're at and help you to get to where you're looking to go. While it's always best to consult with a mortgage loan officer when it comes to qualifying, as each situation can be unique, another way to get a general idea of what your qualification would look like would be to follow along with this example and use it in your own life. Now, one thing to keep in mind is that income qualifying, that for W-2 employees, we use the gross number for the income, not the net income number. So that number that you get before taxes. So in other words, all that money you make before the government takes their cut from you, that's what we're looking at. Let's say this is you, for example, and you make $78,000 in salary per year. You have a car payment of $400, student loan payments of $300, and all of your credit cards are paid off monthly. This means you have total monthly debt obligations of $700 a month and make in salary $6,500 a month. If you take your $6,500 a month and times it by 0.045, which is the 45% DTI we talked about earlier, you get a total of $2,925 a month you can use towards your housing payment. Now don't forget, we also need to take out the monthly debt obligations from this. So taking the $2,925 minus the $400 a month for the car and $300 a month for the student loans, you're left with $2,225 to use for your total housing payment. Depending on the price of the homes in your area, your credit score, the local taxes, the insurance, potential PMI, the program you get into, this could net you a loan probably above $300,000. Now, this might be the most cliche advice ever, but yes, there's a reason for it. It's very, very important, as your credit score might be the most important aspect of the home loan approval. It also takes a lot of time to fix credit-related issues, so it's not something you want to leave as a last-minute activity to fix if you want to be successful. These days, it's also super easy to check your credit scores and reports for free thanks to services like Credit Karma or Credit Sesame. Simply by taking the time to sign up and monitor your credit could make or break it when it comes to applying for a home mortgage. It is also important to note that these services, such as Credit Karma, utilize a FICO score, which is different from what your mortgage score will be. The mortgage credit pull is the most stringent of the credit pulls, and your score will typically be a little bit lower on the mortgage pull compared to what you see on the app. If your scores are not that good, you can tackle the issue by immediately addressing the concerns on your credit report so you're in excellent standing when it comes time to apply. Paying off debt and paying off all your bills on time will help the most. It's also useful to avoid opening new accounts while keeping all of your old ones active. It may also save you a ton of money, as higher credit scores are typically rewarded with lower mortgage rates and PMI rates, which equate to lower monthly payments and lots of interest saved over time. In the mortgage world, a 740 credit score is considered perfect credit for mortgage rates, and the 760 is perfect credit for PMI rates. Typically, credit scores below 700 use an FHA approval, while scores above that go conventional. There are instances when this is not true, but this is just kind of a general rule of thumb. If you would like more information on credit and strategies to improve it, check out some of my other videos. Now let's address assets, which are a close second to credit in terms of importance. It is often forgotten that there are other costs outside of the down payment. After all, you'll need the funds for your down payment, for the closing costs, which is the cost for doing the loan, for prepaids, which are paying for your taxes and your insurance up front by funding your escrow account, and potentially for reserves, which show underwriting you have more money to spare or a cushion in case circumstances change. But it's just one thing to have these funds and another thing to document them. You're typically asked to provide your last 2 months' bank statements to show the lender and the underwriter a pattern of saving money. To make life easier, it could be prudent to deposit all of your necessary funds into one specific account more than 2 months before an application. That way the money will be considered seasoned, and therefore you won't need any explanation letters if the money is constantly going in and out of the account. The ideal scenario might be to have a savings account with all necessary funds and little to no activity for the past 90 days. Asset issues are often red flags for loan underwriters. They hate to see money that was just deposited into your account, as they need to source it and determine if it's seasoned or if we can use it. Now, the same goes for large recent deposits. They need to know that it's your money and not a gift or a loan from someone else, since it wouldn't be technically your money then. To try and think like an underwriter here, make sure that your assets are your own account, so not your spouse's or your parents', well in advance, so that way it makes sense based on what you do for a living and what you earn. If you are going to be getting a gift for your cash to close, it must come from a blood relative, and the easiest way to handle a gift is by not exchanging money at all, but by simply knowing what the amount is, and then during the mortgage process, a gift letter will be signed between all parties involved, and a cashier's check will be made out to the title company on your behalf by the family member, and this will make things easy and not have to go back and collect documents or statements or anything like that. Remember, underwriters don't like seeing the transferring of money, so the idea of a gift comes up. Don't transfer it, just know what the amount is. Try to determine your expected tenure ahead of buying a home. While you might be wondering how to start thinking about the next home before you even move into the first one, the concept is important. First-time home buyers often stay in their first home only 2 to 5 years, with all the changes that occur in someone's life during that time period. If you know or have a good idea of how long you'll keep the property, it can be instrumental in your loan choice. For example, if you know you're just buying a starter home and have pretty strong plans to move in 5 years or less, you'll look differently at that than you would if you plan to turn that starter home into an investment property. You need to truly do a lot of planning ahead to know what the property will be for you before you would even move into it. Now, you hear it all the time. A new homeowner is put into a certain type of loan without so much as knowing what they do with it in the future. Not everyone wants or needs a 30-year fixed mortgage, even though it's by far and away the most popular loan program out there. Perhaps a 15-year fixed or 20-year fixed is the better play, or whether to put more money down or less money down, or whether or not to buy discount points. Whatever it is, do the research yourself before interested parties get involved. This ensures it's more of an objective choice and not just a blind, generic, or biased one. Everyone can go through the process of getting pre-approved, but that process is not necessarily universal. Everyone's pre-approval will be slightly different, and more so if you're self-employed. The last thing you want to do is apply, but then not have the paperwork together to back up your application. For starters, if you are a W-2 employee, most lenders will expect to see your latest pay stubs and potentially your last pay stub from your previous 2 years. And then they'll also need your last 2 years worth of W-2s and a few months worth of bank statements. Essentially, they want to know how you make your money and what you have for down payment and closing costs. Other important documents include credit card and loan statements if you're needing to show off as something being paid off or proof of your assets, such as checking and savings accounts or retirement funds and other investments. If you're self-employed, this would expand out to your last 2 years of personal and business taxes, your current year's profit and loss statement, and 3 months worth of business bank statements, and your firstborn child. Key to note, of course, on the last one. Sort of. Another important aspect with your documentation is your employment history. Have you been at the same job or the same line of work for at least 2 years? Is it stable? Are there any recent changes? Did you have a job gap? Any weird stuff happening with any of your financials? If so, address it personally before the underwriter does. Work out all the kinks prior to giving the underwriter the keys to your file, and this gets done in the pre-approval stage, or it can even get done before that with a consultation with a mortgage loan officer. You can have a professional like me take a look without any cost or obligation to know where you stand. So just remember that. You can get these answers without any cost. It's just a matter of doing the work and being willing to put yourself out there to get the answers. Now this one could drive anyone crazy, even me. You'll see advertisements everywhere talking about interest rates without really explaining them. Why? Because that would take up valuable time or space when the headline rate is really all that is cared about. But what if I challenge the thought that rate isn't everything? What about if you had to pay a bunch of points to get that rate? Do you even know what points are for an interest rate? Or how do they come up with these rates? Why are they different? If I have a different credit score to my neighbor, can I get the same rate they do? Why do they move up and down and change every day? How do I lock a rate, and why do I lock a rate? Or what about if I needed down payment assistance, but it increased the rate to get it? Would the rate be the most important thing then? These are all important questions you should have the answers to. Sure, you don't need to be an expert because it can get pretty complicated, but a basic understanding is a must. This can affect the type of loan you choose, when you choose and decide to lock your mortgage rate, and if you'll pay those discount points we talked about. If you're simply comparing rates from different lenders, you're not really seeing the whole picture, and maybe you should take the time to better understand the fundamentals while you're going at it. Going through these questions and others with a mortgage professional can really help set you up for success. Being prepared early will help your loan application process go that much more smoothly. So I hope this gave you a good breakdown of some of the things you'd want to know before you start the mortgage process. This obviously was quite generic in nature, and your experience will be somewhat different, but being prepared for what's to come will help alleviate any anxiety you might feel towards the process. There's a lot to know, and a lot does go into a loan, but with the right loan officer and the proper preparation, you'll be able to get through it with ease.